In the decade since I was retired, I've learned to tune out most of the investment advice that you see on TV about finding the perfect strategy to outperform the market, for a fee, of course, that comes out of your pocket. Instead, I believe the truth is that we should invest simply and cheaply. It's the only strategy you need. This is the second in 7 simple tips that I've learned in my DIY retirement. Stay tuned. In 2025, 8 in 10 active fund managers underperformed the S&P 500. This is from the longest running study of active versus passive investing from the S&P Dow Jones Indices Company. In most years you see here, active managers failed to beat the market. If you look at the results over the past decade, the statistics are even worse for active management. Less than 1 in 10 active managers can beat the market index. Picking winners sounds strategic, but it's not. And market timing, nobody does it, certainly not those experts on TV. All sophisticated strategies have one thing in common: they cost more and deliver less. My approach to simple investing is to organize your money by time. I use a 3-bucket approach. Some people use a 2-bucket or a barbell approach. In my case, bucket 1 has cash and equivalents that I'll need in the next 3 years. The investing decision is easy. Take no risk. Go to the bank. In bucket 2, I have income-producing assets. Safe investments that I'll use in the following 5 years. These include treasuries and tips and reliable income-producing assets. Then all other retirement assets are in bucket 3, invested for the long-term growth to beat inflation over the coming decade. For the growth in bucket 3, I follow 3 simple principles. First principle is buy the haystack, don't hunt for the needle. When you buy a U.S. stock market index, you own a slice of every publicly traded American company, large, small, mid-cap. Pair that with an international index, and you own a piece of thousands of public companies worldwide. When one company fails, you barely notice. When the global market grows, you grow with it. You aren't hunting for the next apple, you're making sure you don't miss it. The second principle is costs are the only thing you can control. The fee you pay is a return you don't get, compounded every single year. Let's compare 2 retirees, both with a $1 million portfolio with the same real average return of 4.3%. That's after a 3% inflation. Now I'm going to set aside contributions or withdrawals and just focus on the investment costs of that portfolio. The difference of a 0.03% expense ratio and a 1% expense ratio on that same $1 million portfolio over 20 years is staggering. The retiree with the low-cost index fund would grow the portfolio to $2.41 million. The retiree with the 1% fee on that actively managed portfolio would only grow it to $1.98 million. That is some $429,000 less than the low-cost portfolio. The third simple principle is stay the course. Long-term equity investing requires time in the market, not market timing. Our retirement portfolio has endured big market declines in 2018 and 2020 and 2022. The portfolio recovered. The people who sold or stayed on the sidelines didn't fare as well. The bucket strategy gives you permission to stay the course. You can let the stocks ride because you know the grocery money that you need in the next few years is safely in bucket 1. Staying the course also means you rebalance the portfolio on a schedule, not based on market news or emotion. That simple low-cost strategy may be boring, but it works. Assets that you need for short-term spending are invested for safety. Long-term assets are invested for growth through broad, low-cost total market index funds. Hey, the Haystack works. 10 years in, this approach still is working for us. Buy the Haystack, focus on controlling costs, and stay the course with a simple bucket strategy for your DIY retirement. Investing simply and cheaply is crucial, but it's equally important to avoid overpaying for advice. In my next video, I'll explore tip number 3, why avoiding that 1% AUM guy saves you a lot more than money, and what alternatives should you be considering. Hey, I am not a financial professional. There are no initials after my name. So take these as entertaining ideas from one educated DIY retiree who figured all this out in the first decade. Always do your own due diligence and seek out a professional if you need one. If this helped you, would you please take a moment to like, share, and subscribe? It'll help new viewers find this channel. And I'll see you for tip number 3 next week. Thanks for watching.